This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Vanguard's shocking message sparks fears among its customers. I'm going to show you what the investment giant just said and why this is causing outright panic among its customers. And then I'm going to show you all of the evidence of why I think they're completely wrong. Now, before we get to that story, there's another one that I want to show you first to really put everything that Vanguard just said into context and add to the narrative of why I think they're completely wrong. Let's go to Bloomberg, where we picked that story up with a headline: short sellers up their wagers against commercial real estate again, and this is a dangerous game. We talked about in a show the other day about how commercial real estate is a massive risk for the small and mid-sized banks, how the bank term funding program, that cash lifeline that many of these banks have used, is now gone. The Fed has done away with it, and the banks now have to pay this back at a time when we already know that office prices are coming down, and these banks have a lot of loans coming due this year that need to be refinanced. The problem is those who own them don't want to take a haircut, putting pressure on the banks. And what's happening now is short sellers are jumping in on this that could see office prices outright crumble. And that would be a dangerous game, particularly for any investor or any fund that holds this in their portfolio. As investors have been riled in recent weeks by lenders, including New York Community Bank and Deutsche Pfandbrief Bank, setting aside larger provisions for property loan losses. The ongoing vulnerability in offices saw those property values plunge a whopping 15.2% in the year through February in the U.S. This according to an MSCI Real Assets report published this week. And again, this is a problem because a lot of investors, particularly older investors and a lot of funds, go out and buy into these commercial real estate buildings because of the consistent cash flow, the dividends, the payout. This is all going to change in a major way as investors are finally waking up to the fact that rates are not going back to anywhere close to zero. Well, we'll put that to the test here in the future. And the office sector has changed forever. And that's one reason why I keep making the case that during the next recession, you're going to see a huge push by employers to bring people back into the office. Now, I know many people, as you're watching this, saying, there's no way I'm going to go back. The government is going to push this too. You watch. There are going to be tax breaks, incentives, anything to get people back into these buildings. Because one thing people don't realize is they may not care. So what if the value of the building goes down? Well, a lot of local municipalities and governments rely on tax revenue based on the value of these buildings. And when they go down and those tax revenues go down, local governments are going to be in trouble. All the businesses that are built around these buildings to support workers coming into work, they're going away. This is going to be a huge problem for the economy. And any notion now that this will not bring rates back to zero, well, that's almost ridiculous, because we look back at history, we can see once we were at zero, then we went back to zero, and no one said then we're going back to zero, and we did. Now it's like, well, due to the fact we had a pandemic, there's no way we'll ever get back to zero. That's all in the past. But if you look at the yield curve here, shown in blue, which is a 10-year minus 2-year, shown inverted when the 2-year yield is higher, it suggests that post-inversion, well, that means rates are coming down in a big way. And yes, they're high. They're in their plus over their 20-year average here, but notably, there's no reason why it can't come down, because when you think about this commercial real estate disaster and how it's affecting the banks, remember, these banks are sitting on large unrealized losses, not just on their loan book, but on their treasury securities. And the Fed's cut them off from the lifeline, telling them go to the discount window. But the banks don't want to do that because there's a stigma against it. The Fed will have no choice but to go back to zero, to fix these unrealized losses to whatever extent it can, so these banks can offload some of these assets, some of these loans, without taking a loss. It's only a matter of time. But if these investors and speculators that are trying to short sell this sector down get their way, watch out. It'll be all out pandemonium. As short sellers borrow stock and sell it, betting they can profit by buying it back at a lower price later, they're also using credit derivatives and indices and equities to bet against landlords, their debt, and their lenders. That means they're going after everyone, not just the building, the people that own the building, and of course the banks that hold the loan. You talk about the setup for the next financial crisis. It's all centered here in the U.S. commercial real estate market in a big way. And that's one of the challenges as we get to to what Vanguard has said, it doesn't make any sense. And then you start to understand why its customers are so desperate to see anything but what Vanguard is saying come true. And almost 3/4 of shares in the S&P Regional Bank ETF are sold short, an increase of more than 10 percentage points since the start of last week. So here you can see all the evidence that these speculators are coming in a big way and shorting the market. And this is key because when you see this, it tells you there's always going to be opportunity to invest no matter how it is. I want to tell you a story as you kind of look at these recent trades. I got an email from a recent subscriber, came in on the 30-day free trial, got both reports, our CTA report, as you can see here. What do you get with that? You get our daily report and videos on trade tips. And why does that matter? Because we look at the machine positioning, and the way you want to trade this is when machines are deep short and starting coming out of that position, you want to get in. And we run a historical overlay to show you when they're off size. We give you the signals, we give you all of that advantage. Now we also have our Momentum Timer Pro report. It takes a look at those technical signals that people struggle with trading all the time. They get in late, they get out early, they're all over the place. We run an additional signal and give you all the metrics over multiple months to help you handle this in a more efficient manner. Now, together, we took those and we have those reports. Here's what a client or a subscriber just recently said. He got in, and during his initial trial period, get this, he said he made over a 4% return. He transferred $100,000 over, took 2 trades off the report, cut one of them early because it went down, the other went up, made over 4% on $100,000, paid for all his subscriptions for the next several years. You can get in on this. Links in the description below. You can change how you trade, make a ton of money like that guy, because concerns are mounting that problems in commercial real estate may reverberate. More than 40% of fund managers surveyed by Bank of America now view U.S. commercial real estate as the most likely source of a systemic credit event, compared with fewer than 1 in 4 in January. So you think about a systemic credit event, that means rates are coming down. That means opportunities to invest are going to open up. We give you the tools to do that, but it also tells you that the Fed is on the wrong side of this market because they can't see what's going on in the midst of commercial real estate. It's starting to fracture in a big way. And we talked about this the other day because the distress emerging in lending to apartment complexes means investors are paying increased attention to performance of commercial real estate collateralized loan obligations as those debts come due for repayment. And believe it or not, I know people that work for apartment complex developers, and they're telling me, yes, we're getting hammered here on rates. We're hemorrhaging cash. We don't have a lot of time left. And all this is setting up is a massive crisis where the Fed's going to have to cut. And again, it's sort of baffling, as you'll see what Vanguard had to say when you look at all of this evidence and put it in context, because commercial real estate CLOs bundle up floating rate short-term loans that are typically used to acquire and renovate rental complexes. Those borrowers have been struggling after being hit by higher interest rates and falling valuations in some markets. And as these corporate buildings, these commercial buildings get refinanced at lower values, it's going to crush these investors in these short-term loans in a huge way. But for now, offices remain the most visible source of distress in commercial real estate. Those buildings are the collateral for more than 20% of commercial property loans set to mature this year, which means banks are going to have to refi them, and the landlords may have a more difficult time qualifying for a loan extension of those other assets. And why are they going to want a loan extension? Because when everything starts falling apart, the Fed's going to have to cut. The banks are going to extend these loans out somehow, some way. The Fed's going to run to the rescue at 0% rates. Watch and see this happen. Because even in January this year, the market was pricing in 6 to 7 cuts from the Fed, and people were holding out hope that a recession will cure the work from home attitude of the masses. Unfortunately for them, both of those things turned out to be fantasies, but the idea that the Fed isn't going to cut here, well, that doesn't make any sense. And so now we're going to get our lead story here where we take a look at what Vanguard had to say as we look into context of how this economy works here, that we're literally seeing the commercial real estate sector on the beginning phases of implosion. The only answer the Fed has, and remember, they only have one tool because we know the QE, QT thing has really no effect on anything. But we do know the funds rate does. Fed can put that at 0. And here we heard from the Fed yesterday, as Fed officials still see 3 interest rates cut this year, and that's buoying stocks, but not necessarily in a good way, as you'll see a little bit later. While the latest data hasn't given officials a confidence they would need to begin to cut rates, Jerome Powell's outlook for inflation to continue to decline hasn't changed substantially in the recent weeks. The projections recently had Wednesday were a little changed from December and showed most of his colleagues expect 2 or 3 cuts this year. Now keep in mind, the market loves these projections. They're the most inaccurate thing the Fed puts out, bar none, period. If you have any expectations that the Fed knows what they're going to do with rates 3, 6, 9, 12 months from now, they don't. They're just guessing in a big way. There's zero historical correlation to what the Fed actually does and what they project. And on that back, they kept the funds rate between 5.25% and 5.5%, a 23-year high. Now keep this in mind, that nearly the entire curve is inverted. 1 year in rates and longer are below the lower end of the bound. Everything before that is underneath the long end of the bound, telling the bond market, telling the Fed here, you've got this completely wrong. And since officials met in January, economic data has done little to resolve debate over whether the Fed should preemptively take back any of the increases it made last year, when many were worried inflation might settle above 3%. And again, that doesn't make any sense. Why is it that we have a pandemic and now magically, of course, inflation is going to settle around 3%? Why does it settle at 4? Or 5, or 2, or 1, or negative? Why at 3%? And this is something a lot of people don't understand. Just because businesses out there can raise prices doesn't mean they do. So the idea here is if demand is coming down, businesses don't raise prices. The cure for a lack of sales is not higher prices. If you don't believe me, go to a car dealership. Find the car that's been sitting on the lot the longest and ask them if they've been raising or lowering the price. They lower it. That's how it works. That's how business affects. And that's why, as you're now seeing what Vanguard said makes absolutely no sense. I'm going to give you all the data, and this is why its customers are worried, because underneath here, many of them are holding these commercial real estate packages. They've got investments in those sectors and the banks and everything else. What they want to see is rate cuts to support this market rally. And here's what Joseph Davis, the chief global economist at Vanguard, had to say, that investors and policymakers' expectations of rate cuts would prove counterproductive. Well, I disagree with that. To the final stage of the inflation fight, suggesting that now inflation is embedded, it's not going away, and the Fed needs to stay higher for longer. He notes, given the potential for sticky services prices. Again, where is the evidence that anything is sticky to keep inflation from falling? There's a growing prospect that they should not cut at all. And I can tell you this, you look at what Vanguard has, people invested in the equity market sitting now at all-time highs. Everybody wants to know these cuts are coming. The problem is it's not good. Again, they've got holdings in commercial real estate. They've got holdings in the bank. They've got things tied to all of this, and investors need to see a cut. This is not good news. Because other reports, however, suggest consumer spending is cool. And we're going to go through all of these. Hiring surveys have been mixed, but not in a good way. The most widely watched measure of employment growth has been solid. That's the non-farm payroll report, but we know its accuracy is questionable at best. But earlier reports have been revised down by historically large margins, suggesting the government's cooking its books on that too. As wage growth has continued to slow and unemployment has steadily inched up from 3.4 now to 3.9% in February. But let's put the test to Vanguard here, because I told you I disagreed with this at the beginning of the show, and I'm going to give you all the evidence to prove that indeed services inflation is coming down, and that's not a good thing for the economy, and it means the Fed's going to be cutting in a massive way. Let's take a look at the consumer price index. It's going to stay in blue. This is, again, services sector, so we stripped out everything else, and we got advanced retail sales. So again, the notion that consumers are going to go out and spend when, of course, retail sales are showing the opposite direction, well, that means services inflation, as you can see in blue, follows with a lag, and this happens every single time. So the slowdown in retail sales is again validating a decline in services inflation. And if you have a business that deals in services, this is really simple. If you have fewer customers coming in, your solution to your business problem isn't to raise prices. You don't say, not a lot of people are coming in and get a massage today. I think I'll raise my prices by 3 or 5%, and that will really incentivize them to come in and get one. That's not how it works. Businesses run promotions. They run specials. They have sunk costs, expenses that they have to overcome. And in order to do that, you need revenue. And to get it, when things slow down, you have to cut prices. Now let's talk about the labor market. We get some data today. It's continuing jobless claims revised down for the 20th straight week, if you can imagine that. Everything getting revised down to look good. And yet, as Zero Hedge notes here, the Worker Adjustment and Retraining Notification Act, or WARN as it's called, is telling us that as those numbers go up, eventually the government's going to have to get with a program, and we're going to see initial unemployment claims go up. But let's talk about that, because initial claims are sitting at around 210. This is a very historically low number. But how about continued claims? They keep getting revised down, now sitting at 1.807 million. What this is telling us is that virtually all the people in a week that are losing their job, an equivalent number is coming off unemployment and gaining it. But nevertheless, that 1.8 million people is still, while historically low, it's 600,000 higher than it was at its outright low. And that's the challenge here, because those 600,000 people matter in a big way. In fact, when we look at services spending, what we can know is as continued claims rise or stay elevated, well, with a lag, services sector inflation comes down. You see this happen each and every time. In fact, if you look back here pre-pandemic, where continued claims started to bottom out, what happened is services sector inflation came in somewhere between 2 and 3%, suggesting that Vanguard's claim that it's sticky. Well, there's no evidence of that, because we know that continued claims sitting around 1.8 million. What's happening? Services sector inflation comes down with a lag. And it's simple, because the longer people stay on unemployment, the more they lose hope that they're going to get a job. They continue to cut their spending, and it does affect the services sector in a big way. But they talk about average hourly earnings. Let's pick on that as we look at that from the non-supervisory employee perspective. This of course, production and non-supervisory employees in red. And what we see, decelerations, because we know that wages continue to rise even during recessions, just at a slower pace. What that means is with a lag, the services sector in blue does indeed come down. We're seeing, of course, wage growth continue to cool off, and it's matching again a nice lag here, what we typically see in the services sector inflation shown in blue. Again, makes sense as people aren't getting bigger raises. They tend not to spend as much money, and particularly if services sector inflation is running higher than wage growth, you notice that cut that actually happens in spending. And the other way it shows up, which no one wants to talk about, is hours worked. And here you can see average weekly hours of production of non-supervisory employees in red. And even though people are getting higher wages, they're just not getting the same hours, and that affects inflation in a big way. Here you see hours getting cut. This back in the early 80s. What happens? Services inflation goes down with a lag. Happened again. Dot-com bubble, global financial crisis. And look now. This is telling us that historically, based on the number of hours worked, services inflation should be between 2 and 3%, not way up here at 5, suggesting the velocity of this is indeed inflation coming down. The Fed does need to cut. That's where it doesn't make any sense, from what Vanguard's saying here, what the Fed is telling us, because indeed, all the evidence shows that inflation just doesn't drop like a rock unless you're in the midst of a pandemic or a financial crisis or long-standing recession. It is a slow-moving thing. And Powell said while officials didn't see this in the data now, a significant slowdown in the labor market could also be the reason for us to begin the process of reducing rates, because they're absolutely afraid. And yes, he also noted there's long-held view that the dot plot doesn't amount to a plan. Well, that's absolutely correct. He calls the longer run interest rate change, pretty modest. He says, I don't think we know that. Well, whether this will be a lasting trend, referring to inflation. Powell did admit rates are unlikely to go to zero anytime soon. Well, he said, I don't see rates going back down to that level, but I think there's tremendous uncertainty on that. And again, you talk about this commercial real estate problem, and then you look at what Vanguard said, and you talk about why its customers are going to be very upset here and panicking. They need to see rates come down to make this all work out. And if the Fed eases too much or too soon, Powell said, we could see inflation come back. And he said if we ease too late, we could do unnecessary harm to employment. because they want to be careful. The risks here are really two-sided, and sure enough, you come back to the yield curve, and what's happened here is the Fed has artificially pushed the funds rate above what the market is telling him he should have it priced at, and that is the problem. When you see these inversions shown in blue, what follows is, of course, continued increase in continuing unemployment claims each and every time. Of course, we talk about panic in the market, what this means for investors who are looking at all-time highs. Well, you notice what follows inversions is a steepening of the curve or declining rates that everyone wants. But that also means the markets historically come crumbling down. This time, everyone believes it's different, but as we know, it never, ever is. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.